Good afternoon, everybody. Welcome to Liberty Call. Today is Tuesday, July 18th, 2023. Hope everybody's having a fantastical day out there in the interwebs. The markets seem to be pretty happy today. The Dow was up over 1%, S&P was up, and the NASDAQ were both in the three-quarters range as far as being up. I see a ton of green, except in the overnights in Asia. I see a lot of red there. But let's go ahead. And before we get started, thank you very much for being here. And if you could, please give me some thumbs up. Excuse me. Thumbs up, like, share, subscribe, follows. I would greatly appreciate it. And it's also Astros Day here in Colorado. They are here to play the Rockies today and tomorrow. So tonight game, 6:40 Mountain Time. And then tomorrow's game is a day game. Not going to that one. So it looks like we might have a little overcast. So we're welcoming the clouds because it has been quite hot here the last couple of days. I think it got up into the low 90s yesterday. And in my bedroom, I think it got as cool as about 75 degrees last night with the windows open. So was not quite comfortable. Anyways, let's go ahead and jump into the numbers. All righty. Okay, so the Dow Jones was up 1.06% today, 366 points, closed at 34,951. S&P 500 was up 0.71%, closed at 45,54. NASDAQ was up 0.76%, closed at 14,353. The VIX fell 1.34%. It's currently holding at 13.3. Canada was up 0.74. Brazil down 0.32, the lone laggard here in the Americas. And Mexico was up 0.86. Over in Europe, Germany was up 0.35, the UK was up 0.64, France was up 0.38, Netherlands up 0.13, Spain up 0.19, Italy up 0.34, Switzerland up 1.16%, and Portugal up 0.61. Russian exchange is both green, MOEX up 1.27, RTSI up 1.5. And the overnights, starting out with the Nikkei in Japan, it was up 0.32%. Australia was down 0.2, New Zealand up 0.09. In China, the Shanghai was down 0.37, the Shenzhen component down 0.34, China A50 down 0.49, DJ Shanghai down 0.24. The Hang Seng was down 2.05%, so that's a pretty big jump there. And the Taiwan weighted was down 0.61% for the day. So, like I said, I'm not sure why everyone's all excited. And I mean, yeah, the report's coming out, earnings are looking decent right now. I mean, we are only a couple days into the earnings season, and last week's numbers look pretty good. I think it was Chase, and I forget who the other bank was, but some of the other articles I've read this week have said that some of the other banks are not in quite the same good condition. So, all right, let's go ahead and jump into the market recap. There we go. S&P 500 rides rally and banks higher. The S&P 500 experienced a significant jump on Tuesday as investors celebrated better than expected quarterly results from a range of major corporations, including Wall Street banks. Bank of America led the surge in banking stocks, with its shares rising over 4% after reporting second quarter earnings that exceeded analyst estimates. The bank benefited from higher interest rates, which boosted its loan income. Morgan Stanley also experienced a rally, with its shares rising 5% after beating estimates on both the top and bottom lines. In its second quarter results, the strong performance of its wealth management business offset weaknesses in trading due to a drop in equity and fixed income revenue. Charles Schwab was among the top gainers, with its shares increasing by more than 12% following better than expected quarterly results. In tech sector news, Microsoft saw a 5% increase in its stock price as investors flocked to the company based on optimism surrounding its AI capabilities. Microsoft announced it would charge businesses $30 per user to access its suite of AI tools, leading to positive market sentiment. Tesla and Netflix also experienced a boost ahead of their quarterly results, which were scheduled to be released after the market closed. Investors were particularly interested in Tesla's margins following recent price cuts and Netflix's subscriber numbers and guidance after the company's crackdown on password sharing. Ooh, no one does that. We do. While retail sales in June rose 0.2%, falling short of economists' estimates, the data suggested a moderation in consumer spending. However, economists still expect the Federal Reserve to raise rates for the final time next week. I don't know if it's going to be the final time. I'd say there's probably some good odds in the September meeting they'll raise rates, as the positive retail sales figure indicates that the economy is growing at a moderate pace. Overall, the positive earnings results and market reactions underscored investors' confidence in the resilience of major corporations, particularly in the banking and tech sectors. All right, so that's everything there. Let's Let's move on to some news about the dollar. Dollar bounces from 15-month low on strong core U.S. retail sales. The U.S. dollar rebounded from a 15-month low against a basket of currencies on Tuesday. Yesterday, we talked about the dollar and its fall from where it's been in the last, 10 months. Following stronger than expected core retail sales data for June, while headline retail sales rose by 0.2% during the month. Below expectations, core sales excluding automobile, gasoline, building materials, and food services increased by 0.6%. This resilience in core sales suggests progress and supports the view that the Federal Reserve may hike interest rates again later this month. The dollar had previously weakened after slower consumer and producer price gains in June, which had raised expectations that the Fed would pause rate hikes after the upcoming 25 basis point increase. However, the positive core retail sales figure indicates that domestic demand remains strong and supports the case for further rate hikes. See how these articles, one says they're going to stop, the other says they're going to continue. I mean, these people don't have any clue what's going to happen. Traders will also be monitoring inflation releases from regions such as the Eurozone, Britain, and Japan this week for additional insights into global inflation trends. The dollar index, which measures the value of the dollar against a basket of major currencies, was slightly up at 99.924, recovering from its earlier low since April of 22. Bank of America analysts noted that recent weakness in the dollar has exceeded the drivers of the move and attributed it to stretch positioning and sentiment as well as technical factors. They expect the underperformance of the Japanese yen to resume once the market stabilizes. The euro remained relatively unchanged at 1.1229 after reaching its highest level since February of 22 earlier in the session. The European Central Bank Governing Council member Klaas Knot emphasized the importance of monitoring inflation cooling in the coming months to avoid excessive rate hikes. Yeah, they don't want to raise those rates too darn high. We'll be afraid if the economy actually, prices actually went down. Where were we? The British pound the British pound dipped slightly to 1.3046, and the Australian dollar edged lower after the Reserve Bank of Australia's July policy meeting minutes revealed no major surprises. Overall, the positive core retail sales data provided a boost to the U.S. dollar, suggesting ongoing economic strength and the potential for further rate hikes by the Federal Reserve. So, like I said, one article says, hey, they're going to stop raising rates and, they're going to cut rates and do all this stuff. And then the next article talks about how the fundamentals in the economy are not that great and are not what they want to see. And they're going to continue to raise rates. So, again, which way we going? All righty, next up, why U.S. citizens should not accept 3% inflation. Something I say quite a lot. Well, I always say 2%, but this is written by Daniel LaCal. Let's go ahead and jump into my notes here. All right, a recent University of Michigan survey indicates that one-year inflation expectations rose 3.4% in July, while five-year outlook increased to 3.1%. However, the mainstream narrative is that 3% annual inflation rate should be accepted as success is misguided. In reality, such inflation erodes the purchasing power of currency and has detrimental effects on wages, savings, and the economy as a whole. So, let me step aside here, and you can use the rule of 72, which is something that we in the financial business use just for some quick math. But if you divide something by 72, so let's just say 10%. So if something has a 10% interest rate, it will double in value every 7.2 years, because if you divide 72 by 10, you get that. If you do it by 5, it would be, twice as long. So at 3%, your cost of living doubles every, 20 something years. So, I don't see 2 or 3% as really good. I'd like to see flat or, actually weight or prices going down so that my dollar goes further. But, unfortunately in this economy, that's the Fed doesn't like that. All right. Rising long-term inflation expectations are not positive, as they confirm the destruction of real wages and savings. Moreover, they provide incentives to maintain inefficient and unproductive sectors of the economy while discouraging innovation and technological advancements. Despite this, many market participants are calling for more quantitative easing, that's money printing, driven by the desire for market bubbles and increased asset valuations as the expanse of the economy growth and at the expense of the economic growth and productivity. The evidence from the past 6 months shows that the rise in the S&P 500 has primarily been driven by multiple expansion rather than sales and earnings growth. This reliance on multiple expansion indicates its a need for easing to sustain the market. However, a 3% annual inflation rate translates into higher prices for essential goods such as food, utilities, and gas, putting a strain on households. It is crucial to understand that inflation is not caused by commodities, wages, or profits, but by the constant increase in the quantity of currency in circulation. Government spending plays a significant role in this inflationary process, as newly created currency is predominantly consumed by the government. The persistent deficits and massive financial asset inflation contribute to the erosion of purchasing power and the struggles faced by the middle class. Ignoring the destruction of the economy and the middle class to justify more government spending or superficial increases in asset valuations is a misguided approach. The focus should be on fostering the thriving middle class and promoting productive investments to strengthen the economy. Monetary easing, while temporarily boosting financial assets, ultimately weakens the fabric of progress and supports the expansion of government at the expense of economic stability and prosperity. So, yeah. So anytime you hear these yahoos say, well, we want to get back to our 2% target because that's where everything is fine, it's not really fine. Again, at 72 divided by 2%, the cost of living doubles every 26 years. That's not very long. I've been in the workforce since 1989. That was 35 years ago. So, back when I was riding my bicycle up to Kroger to bag groceries, I was only making $3.25 an hour plus tips. But the cost of a Coke or a gallon of gas, everything has gone up exponentially. Gas at the time when I turned 16 the next year was about $1 in Texas or in the Houston area. And today you're going to spend anywhere from $3 to $4 for, gas or diesel. So it's not a good thing. All right. Last up on the docket today, the BRICS currency project picks up speed. We've talked a lot about this in recent months that, if the BRIC countries go forward with their currency plan, could be some serious bad news for the dollar, especially since they're planning on pegging the BRIC currency to gold. At least that's a scuttlebutt right now. So we know what the fiat dollar is not attached to anything, so it gets devalued constantly. All right. News has emerged that the BRICS, Brazil, Russia, India, China, and South Africa plan to introduce a new international currency backed by gold for trading and financial transactions. This development, which aims to reduce dependency on the US dollar, could have significant implications given the size of the BRIC countries' economies and populations. The U.S. has frequently used the dollar as a geopolitical weapon, imposing sanctions and restricting access to the U.S. dollar capital market and international payment systems. This has led countries to restructure their foreign reserves, reducing their holdings of U.S. dollars and increasing their gold purchases. Smart. The freezing of Russia's currency reserves has highlighted the political risks associated with holding U.S. dollars. While details about the new BRICS currency structure are not yet available, speculation suggests the creation of a BRICS bank funded by gold deposits from BRICS central banks. These deposits would be shown on the bank's balance sheet as BRICS gold and could be used to grant loans denominated in BRICS gold to exporters and importers. The BRICS bank could also accept gold deposits from international investors, allowing them to hold interest-bearing BRICS gold deposits. BRICS gold could then be used as an international unit of account in global trade and financial transactions, potentially replacing the U.S. dollar. I wouldn't be shocked. The dollar is trash. However, this transition would have far-reaching consequences. The demand for gold would increase, leading to higher gold prices in all currencies and devaluation of fiat currencies, including the U.S. dollar and BRIC currencies. I'm sorry, not BRIC. Probably the European. Prices of goods in terms of official fiat currencies could skyrocket, eroding their purchasing power. The BRICS countries would build up gold reserves as they run trade surpluses, positioning themselves as winners in this currency shift. On the other hand, countries with trade deficits such as the U.S. would face losses. These plans have potential to disrupt the global economic and financial structure. The upcoming meeting of the BRICS countries in Johannesburg will shed more light on their intentions regarding the creation of a newly gold-backed international trading currency. So, like I said, this is bad news for America. The gravy train is about to run out on being able to print money and make use of it and let everyone else suffer the consequences of devaluing the currency. But they could be proactive and try to pay down the debt over the next couple of years. Have a fiscally responsible government, but it's more fun to just print money and blow up brown people halfway around the world. Well, and also Russians. They don't like the Russians either. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening. Watch the Astros tonight. Maybe you'll see me. I'll be 7th row up from the home plate. So anyways, hope you have a good evening, and I'll talk to you next time. Adios.